Hello everyone, this next video will be on taxes, and that's what we're talking about. I'm a little weird when it comes to taxes, and since I teach personal finance, it makes it even a little more weird is I don't actually recommend you do your own taxes. And when I say do your own taxes, what I'm talking about is using or doing the old school 1040 form that you get down at the post office or the library and filling it out and making sure you have everything in the right lines and forms and stuff like that. But instead, you either use software. You can actually get your taxes done for free through the IRS. They have a free file option and do it electronically online, where I think they outsource that to like a TurboTax or something like that. So again, if your income is less than $62,000 a year, I believe you can go ahead and use that free file option. And if it's more than that, I usually recommend your income's higher than that. Either recommend doing a TurboTax or having a tax preparer actually do it. And I can illustrate sort of why I recommend doing that with a story. A number of years ago, a friend of mine who was in a very interesting position where on the weekends they could work extra hours. They worked in a field of science, and they were kind of in this exempt, non-exempt job where they couldn't get paid overtime, but they could get paid for working overtime. They could get their hourly wage. Again, it was kind of a weird, I don't know how their employer structured it. So in other words, they could work on the weekends or work extra hours and things like that. Again, not getting overtime, but getting the regular pay. And they made about, I think it was $25 an hour, I want to say, to do this work in a laboratory and science field. But one weekend, this gal was decided that she was going to do her own taxes and went and got the forms and had planned on doing this and sat down and started going through it. At the end of the weekend, she was real proud of herself for going through and doing her own taxes, and she looked at how much money she saved by doing her taxes herself using the old school method. And she figured she saved about $70 compared to doing it through TurboTax or one of these other places. According to her, that's what she thinks she saved. The problem with that is it took her about 18 hours, 2 full days over a weekend to complete her taxes. So if you figure out, we might as well pull up a calculator here. She saved or spent 18 hours times $25 an hour. So she spent $450 worth of her time to save $75 is what she figured she saved. Now, when we talked about opportunity cost earlier on in the section, you can see, well, then she really had an economic loss. We take $450 minus the $75 she thinks she saved. She actually lost $375 by spending that weekend doing her taxes instead of working. And again, the reason I bring this up as an illustration or a point to make is we live and work in an economy that is based on specialization of labor. And my friend's specialization was working in a laboratory doing some sort of science thing. I still don't really understand what she does. But that's her specialization. That's what she's good at. And she gets paid well for that. In this case, she was trying to do her taxes herself, I think to be frugal, maybe because she wanted to learn more about that. And it's not that I recommend people don't do their own taxes, but my thinking is if you're going to do your own taxes, then go and get certified. And I apologize, I don't remember the body on that. But get certified or licensed to do other people's taxes. If you're going to learn how to do it once, you might as well keep on doing it and do some moonlighting during the holiday season to complete other people's taxes. And that's why I recommend that if you're going to do your own taxes, fine, but then do them for other people. Don't waste the time to learn how to do something and not sort of make some money off that. In the case of my friend, she had actually lost $300 some. So that's my opinion and my take on doing your own taxes. What we're going to go through today is not actually, we got to be careful how I say that. We are going to go through the formula of how your taxes are completed. We're not actually going to fill that out in the 1040 document, and I'm not going to show you and go through all that, but we'll go through so we have a basic understanding of how your taxes are determined. First thing we need to know is that our income taxes are based on a progressive tax system, and that's where the higher earners are taxed at higher rates. Now, we figure out first your marginal income tax rate. We can see that if we open up moneychimp.com here, and we did this for the earlier exercise. I'm going to use me as an example. I make somewhere between this amount of money, and I am at the 15% tax bracket. The thing is, though, I don't actually get taxed at 15% because the first amount of money I earn, $0 to $9,275, I'm only taxed at 10%. That means that will always shrink your tax rate. So if I plug in my taxable income, it tells me my marginal income tax rate is at 12.89%. And that's how we figure that out if you want to quickly figure out what your marginal income tax is. Now, businesses, and as we saw on that chart, that the higher tax bracket you're in, the more you're taxed. Now, everybody sort of says, well, aren't all tax systems progressive? Because usually that's the case. And the answer is no. Our business income is actually taxed on a progressive, regressive income tax system where those tax rates fluctuate. And that's done as a surcharge to slowly even out the amount of money people are taxed, so there's less of a steep curve, except for those that earn, billions of dollars. So something to know, and you'll see that on a test later on. So we're going to go through step by step how it is to complete your taxes, and hopefully we won't miss anything. First thing you need to do is be employed. You have to have a job. And this gets started when you go to that employer. You fill out what's called a W-4 form. In this W-4 form, you write down your marital status and put down if you have any dependents. Usually we think of dependents as children, but it can be anybody that's dependent on your income to live. All right. Now, one of the things I want to talk about here is when I was in the Marines, I had a roommate that said to me, Bruce, why don't you claim yourself as a dependent? And you can do that. I can claim myself as a dependent because I am, in fact, dependent on my income. And what will happen is, throughout the course of the year, I will have more money taken out of my paycheck to be set aside to pay my taxes. And at the end of the year, when I file for a tax refund or figure out if I have to pay in to the IRS, what will happen is I will either get a refund and get money back, or I'll have to put money to pay the IRS. Well, I didn't file as myself as dependent at the beginning of the year, and then at the end of the year, they simply said, okay, I was dependent. So I only had, let's say, 10% of my paycheck taken out to pay the IRS. Now, my roommate said, Johnson, why don't you claim yourself as a dependent? And what he would do is he thought if he claimed himself as dependent, that at the end of the year he'd get more of a tax refund. And this is true. But what he never realized is the reason he got more of a refund back is throughout the year he was giving money to our employer who was paying the IRS and quarterly for taxes or income taxes. And what was happening is he was setting aside that money at the end of the year when he tallied up to see what he actually made and what actually happened. he would get a refund because he had paid too much in taxes to the government. A lot of people think that there is a gaming to the tax system, that if you do certain things, you'll get more money back, or all sorts of other goofy stuff that, go to this tax person because they'll get you way more back or something like that. And the reality is there is no gaming the tax code. There's no gaming the system. If you think that you're getting more back, it's not that you're getting more back, it's that you gave too much to Uncle Sam to begin with. And that's usually what happens. There is, however, a couple situations where you can actually get paid more back than what you put in. Another acquaintance of mine contacted me one day and didn't understand something. They were dating a gal who had a few children, and she had done her taxes, and she actually got a refund back that was more than what she had put in. In other words, she made $30,000 this year, paid $1,000 in taxes, but was going to get a refund from the IRS of $1,400. Okay? That can happen, and usually that happens because of something called the child tax credit. The Child and Dependent Care Tax Credit and Earned Income Tax Credit. Unmarried taxpayers who support a dependent may be eligible to file head as household. These folks might get more back. Typically, folks that are low and median income individuals and couples, primarily for those that have qualifying children, when the credit exceeds the amount of taxes owed, it results in a tax refund to those who qualify and claim the credit. That is, this credit is refundable, and this tax credit is provided in part to offset the burden of Social Security taxes and to maintain an incentive to work. So again, it is possible to get more back than what you put in. All right. Now, another thing I want to touch on before we get to the process is a lot of times my wife always comes home if she gets a bonus, and she never understands it because she'll get a paycheck or a check, looks like a paycheck with a paycheck stub, and about half of it will be taken out. Well, the reason that happens is because typically bonuses are not paid out as normal income. And when that occurs, and it looks like a special payment, it looks like you're making that amount of money throughout the entire year. So what the payroll software usually will do is they're going to pay the government, the IRS, when it comes time to pay for taxes, as if you're making that money hourly, weekly, usually in a short time horizon. So it's going to ultimately take quite a bit out for taxes. Don't worry, you'll get a lot of that back when you file for a refund at the end of the year. So oftentimes, again, people think that, wow, bonuses are taxed at higher rates, when actually that's not the case. It's just too much gets paid in, usually when those bonus checks get cut, and it's because the payroll software forces that. But again, usually you'll get a paycheck back. Couple notes: if you're self-employed, you are required to follow an alternative tax filing procedure that we're not going to go through in here, which may require you to calculate your net and gross self-employment income on a recurring basis throughout the year. Make sure you keep accurate records of all your revenue, and most especially, I would say this, if you're self-employed, you should have your own personal checking account, and your business should have a separate checking account. And that money should never get intertwined. Okay, you want to separate those funds. For one reason, make life a little easier for you. But if you ever get audited or are having financial problems in the future and it gets into a legal circumstance, it's far easier and looks much better when you have separate accounts for your personal life and an account for your business life, and that does not get intermixed. All right, so after step one was to get a job, be employed, fill out a W-4 form. The next step is after January 15th of the year, you're going to start getting a bunch of tax forms in the mail. That'll include W-2s for employment income and 1099 and 1098 forms. And these are forms that are used to complete your taxes for the year. Now, there is a law that all these documents need to be received by February 1st. When I was working in banking a number of years ago, I had to complete these forms and get them sent out to clients of our bank, and there were thousands and thousands of these documents we had to send out. And ultimately, our printer broke down, our software system broke, so we were trying to figure out how in the world are we going to get these sent out, and we ended up having to file an extension with the IRS. And the IRS is as serious as a heart attack when they said this stuff needs to be sent out by February 1st. So you get these documents typically in the mail or sent via email by February 1st, and I would say probably no later than February 15th is usually when these stop coming in the mail. They have to be date stamped prior to February 1 through the Postal Service. So you get these 1099 and 1098 forms. 1099 forms are for income, usually received from investments. There's 1099 DIV, 1099 INT, 1099, a bunch of different ones that you can receive. And again, those are money coming in or income that you've received in some form. Then we have 1098s. And 1098s are for kind of money going out. The 1098C, for example, is details the donations of a vehicle or a boat or an airplane to a nonprofit. 1098E is for interest paid on qualified student loans. And we have 1098Ms, 1098Ts, all sorts of 1098s. Sorry if I said 1099 there. Another one would be the 1098T, which details tuition and related fees during the year. And again, we use these forms to file your taxes. So I would say beginning of the year, around January 15th, start double checking your mail. And most mail that has a tax document on it is going to say something like tax documents enclosed. Now, unfortunately, there have been some companies out there that have started stamping mail with something that looks similar to that. But I would recommend make sure you go through all your mail and even your junk mail when you start getting that sent out, so you make sure you have all these 1099s, 1098s, W-2s, etc., and any other tax documents. Then what I do is set all these forms aside in a file cabinet somewhere or in an envelope and make sure you keep them. And when you get ready to file your taxes for the year, then you can dig them all out. All right, here's a list of a bunch of different 1099s, again, which are income, or looked at as sort of income or money received. And you can Google that list, I'm sure. And then we have 1098s. 1098 could be for mortgage interest that you paid throughout the year. 1098C, I already talked about that one. 1098E, if you have student loan interest that you've paid, you'll be receiving one of those. 1098T is tuition if you paid a school for tuition. So this is the basic calculation to figure out if you should be receiving a tax refund or if you end up having to pay in the IRS. And I'm going to go ahead and change this over. We'll continue going through this. But I'm going to have this formula up as we go through the rest of this PowerPoint. So we know what we're looking at. So the first thing we start off with is your gross income. That's your starting point. That would be your W-2s that you get for your income throughout the year. From there, we subtract deductions, or it's commonly known in the world of taxes is above-line deductions to the gross income. Once we take those away, we have what's called our adjusted gross income, which is usually called AGI. Then we have to figure out whether or not we can claim a standardized deduction or if we should file an itemized deduction. We subtract that from our AGI, or adjusted gross income, and we also subtract any exemptions. What we have after that is our taxable income. We take our taxable income and multiply it by that tax bracket, or the tax rate for our level of income, and what we have is our gross tax liability. From there, we subtract any tax credits and prepayments, and what we are left with either is a positive or a negative amount, in which case that would tell us that we owe the IRS or the IRS owes us money. So from the starting point, the calculation of taxable income begins with all gross income, and gross income includes all income. Anything that's coming in afterwards, you do the deductions. So unless the tax law or tax code provides a specific exclusion. So this is going to include all our W-2s and our 1099s. Okay, that's how we get our gross income. Now, from there, we can put in above-line deductions. Okay, this is above-line deductions, and we're going to subtract those. Those include deductions for 1098 forms. Okay, and they include student loan interest, tuition and fees deduction, certain educator expenses. That's if you're a teacher and you're using some of your income to pay for items in a classroom setting, maybe a chalkboard or something like that. We can deduct any alimony payments, trade or business expenses, certain reimbursed employee business expenses paid under an accountable plan, moving expenses, a penalty or early withdrawal from savings, and contributions to qualified retirement plans. Again, we can deduct all those from our gross income. What we're left after that is then what's called our AGI, or adjusted gross income. The amount of adjusted gross income is sometimes referred as the magic line, since it's the basis for several deduction limitations. For example, the limitations on medical expenses is one. A taxpayer's adjusted gross income is used to determine the phase-out of otherwise allowable itemized deductions and personal dependency exemption amounts. So again, take our gross income, we subtract the above-line deductions. What we're left with is our AGI. Then from there, we have to determine whether or not we can subtract a standard deduction or an itemized deduction. Now, you can go to the IRS.gov and figure out both these. So the next amount we're going to figure out is the greater of a standardized deduction or itemized. Now, let me give you kind of an idea of this. Certain medical expenses can be listed under itemized deductions. My mother and father always file and keep records of every time they're in the hospital, because often throughout the year they will spend more than $25,000 at the hospital that qualify as one of these possible deductions. Again, $25,000. So they can either subtract this or subtract a standardized deduction that we're going to find from the IRS. So when we go to irs.gov, answer here, how much is my standard deduction? And information we're going to need is your age, spouse's age, and filing status. I'm going to pretend I am single. Basic income information, including amounts and adjusted gross income. We're going to go ahead and begin. Takes about 5 minutes. So we start here, how much is my standard deduction? The following set of questions will help you determine the amount of your standard deduction. Please click continue. What tax year are you asking about? We're going to ask for 2015 to file for 2016. Marital status. I am going to go ahead and say I am married. I'm going to be single for this one. Hopefully my wife won't watch this video. Filing status. What is our filing status for 2015? And our filing status, I'm going to put single. Get rid of that. Tax return period covered. Will your 2015 tax return cover a 12-month period? And I'm going to put yes. Date of birth. I was born on the 26th of March, 1975. That's not my real birthday, but did you provide more than half of your own support for 2015? Yeah. Yes, I did. Blind. Were you blind on the last day of 2015? No, I was not. Now, some of you might be asking, what does that have to do with anything? We'll go back and we'll look at it here in a minute. How much is my standard deduction? And it says in 2015, my standard deduction is $6,300. So I'm going to write that down on my piece of paper. So my standard deduction is $6,300. Now I'll keep all my itemized deductions throughout the year, that certain medical expenses and those things. And if they total more than $6,300, then I'm going to take those and subtract them from the adjusted gross income. Now, if my itemized deduction is less than $6,300, I'm going to enter in 6,300s because I get to take the greater of the two, either a standardized deduction or itemized deduction. Now, as I said before, this would probably double or get much higher if you were filing jointly. But I told you my parents, who are older in life, they're past retirement age, they have a significant amount of medical bills that they can deduct, so they would want to put the itemized deduction. My wife and I don't have many of those types of deductions, so we typically just get the standard deduction. Okay, so from our adjusted gross income, we would select $6,300 because if we itemized our deductions, it probably would only come out to $1,000 for the year. So we're going to pick that. Now, as I said, we'll go back and see what happens if you're blind. Do the back arrow. Were you blind on the last day of 2015? And we'll put yes. Your blindness increases the amount of money you can deduce, and about $1,550 for this circumstance. So you can deduct a little more. Kind of interesting. All right. Now down here is an allowable or an itemized list of allowable deductions. We'll go ahead and look at that to give you more of an example. Medical and dental expenses are sometimes allowed deductions you can put when you itemize. Certain taxes, if you're paying property taxes, for example, can be deduced. Home mortgage points can be subtracted. Interest expenses, charitable contributions, business use of a home, business use of a car, business entertainment, work-related education expenses, employee business expenses, and these other things can be considered itemized deductions. This is usually the reason why you want to work with either a software system or a tax preparer, so you make sure that you can have you're adding in all of these possible deductions. From there, we can subtract exemptions. Now, these exemptions can also be found at the IRS.gov. And down here, we can find these different types of exemptions. So typically you can claim yourself or claim an exemption for yourself and any of your dependents. Whoops, jumped here. And this is where you can find it. I believe in 2014 or 2014 it was like $3,900 to file you as an exemption, and $4,000 I believe for 2015. Let's see if I can find that again. No, but I'm pretty sure I'm right. Anyway, we'd file that down, and I'm going to put, personal exemption rises $3,900 up from 2012, $3,800 in 2013. Some of this information is pretty quick to find. There we go. 2015 tax personal exemption rises to $4,000 and up from $3,950. So I would go ahead, and if I go back to this, my exemption would be $4,000. So if I say had gross income of $40,000, okay, I didn't have any deductions for gross income. $40,000 was my adjusted gross income. I took a standardized deduction of $6,300 and an exemption, subtracted that. We would get $40,000 minus $10,300. That's $6,300 for a standardized deduction, $4,000 for an exemption. We would have taxable income of $29,700. Now, if I go back to that Money Chimp, tax calculator, we multiplied in this case by our actual tax bracket. So I made $40,000. I'm in the 25% tax bracket. So I'm going to multiply $29,700 times 25%. So my gross tax liability is going to be $7,425. From there, I would subtract any tax credits and prepayments. Now, most of us prepay throughout the year via our employer. Okay? We can subtract any of these for tax credits and prepayments, including household and dependent care credit, elderly and disabled person credit, child tax credit, American Opportunity, so on and so forth. Any of these we can subtract from our gross tax liability. Now, I am going to put that I paid in throughout the year $8,000. So what I do is subtract this from this, and what I would get is difference of $575. Okay, be negative if I subtract that from that. This would mean that the IRS owes me $575 because I paid in $8,000, but I only owed $7,425. So again, they would send me a refund. Now, if this were flipped and I owed the IRS, my gross tax liability was $8,000 and I only paid in $7,425, then I would owe the IRS $575. From there, you file that you completed your taxes, and you either wait to receive a refund or you send in money to the IRS. And that, in a nutshell, is how you complete your taxes. If you want to read more on this, I would go to bankrate.com and put in taxes, or file or enter into their search engine at bankrate.com taxes, and it'll show you a step-by-step on how to complete your taxes. Again, I would definitely not recommend using, escape out of that. I would definitely not recommend using the old 1040 form and using that for anything. I would file them online. Again, if you make less than $62,000 a year, you can use the free file option, which is basically like TurboTax on the irs.gov website. All right, let's see what else. Again, it is possible to get more of a refund than what you paid in, especially if you have a low or medium income individual or you're a couple, and usually you have qualifying children where you can get a tax credit, and that exceeds the amount of your taxes owed or your tax liability. If that's the case, that's one of those times where you can get more back than what you paid in. All right. Again, this is $62,000 for 2015. And usually you can get that free on TurboTax websites, wherever else. All right. Now, I told you that I personally am not the type of person that recommends doing your own taxes. A number of other professionals, one in particular, Jeff Schnepper in 2009, is an author and tax attorney, suggests when you're doing your taxes and whether or not to hire a professional, you ask these three questions. One, are you prepared to give your taxes your time? According to the IRS in 2007, it took 24 hours were spent on an average filing when an individual non-professional completes their own taxes, and 52 hours on average for more complex filings. So you need to ask, are you willing to give that kind of time to do it yourself, filling out the old 1040 form and not using the cheater method, if you will, or hiring a tax preparer? The next question is, are you prepared to put up the cash to hire a preparer? Now, I would say I have fairly complex taxes. I have a number of business investments and have money involved. My wife does in some agricultural dealings with her family. And we pay anywhere between $75 and $100 to get our taxes completed, and sometimes a little more than that if we have some huge changes to our previous year's taxes. For me, that's more than worth it. So I'm more than happy to hire a preparer, and I can spend my money elsewhere trying to earn more money. See, one of the things to remember is, when it comes to saving money, there's a limit to saving any amount of money. There's always going to be a limit. But when you focus on revenue and income, typically there's not a threshold. There's no law that says you can only make X amount, typically. So that's why we often look at looking at trying to earn money and not necessarily on save money. The last question is, are you prepared to deal with the complexity of the federal tax code? Now, I think it's important that you know the different impacts and implications of the different deductions, standardized deductions, exemptions, and any tax credits. It is good to know that. But that doesn't necessarily mean you need to get spend hours and hours and hours trying to complete your own taxes in the forms. Again, I advise using the IRS free file option if you make less than $62,000 a year. Now, here's the thing. I believe if you start doing your own taxes, then you might as well keep doing your own taxes and then show other people how, or excuse me, do taxes, complete taxes for other people. Now, some advice that's out there is if you do your own taxes, about every 3 to 4 years, you should consider hiring a professional to make sure that something's not getting missed. Again, things to think about. Couple more tips. When you're getting your mail from January 1st to February 15th, check to see if it has a tax document enclosed on it or something to do with taxes. Again, set that mail aside and save it because there's likely, well, you want to open it up to see what documents in there. But then set that aside so when you get ready to file, you have all that you need. So you start collecting all your tax documents starting January 1st. You're looking for your W-2s from your employer, 1099s, and 1098s. Now, the date changes every year to deal with weekends or other predetermined delays, but for the most part, tax documents must be mailed by January 1st. Now, here's the thing. You always get antsy people out there that want to get their taxes done because they can get their tax refund as soon as humanly possible. But it's often advised that you do not complete your taxes prior to February 15th-ish of that year. You may want to wait until after February 20th to actually sit down and go through and complete your taxes. And the reason is you may have not received all your tax documents yet. The problem with that is the IRS gets, when you get a W-2 or you get a 1098 form, the IRS gets these same forms and gets the same information. So if you're filing your paperwork and you don't have it all complete, but the IRS has all of their information complete, you might have a little bit of a problem here. Now, it's probably not likely you'd get audited, but it's going to be inaccurate, and you're going to cause more work than you need to. So, piece of advice, don't do your taxes before February 15th for the previous year to make sure that you're getting all this done. And just as a reminder, taxes are due April 15th of every year. Make sure you get that done, okay? And, again, set that on your calendar. You'll see it in the news. Make sure you get your taxes in. Now we're going to talk a little bit about Social Security, Medicare, and Medicaid. Social Security is, in Medicare and Medicaid, we pay taxes towards each one of those. This is a paycheck stub, and to explain what money is coming out where and why, you can see up here. First, we have federal income tax, and that's usually coded on a paycheck stub as federal withholding. Okay, that's your basic income tax. Then you have your Medicare tax coming out for that. And Medicare is a health insurance, government-run sort of health insurance program for people that are older than 65. Or 64, depends on, you can sign up early. So once you turn that age, 65, you normally don't get insurance any longer through a regular insurer, but instead you would get it through the government. Now, a lot of people, the taxes you pay throughout your working years pay then for this health care that you're going to receive in your latter years. It can be if you at the age of 65 were to insure yourself and not use the Social Security, Medicare at that age, it would cost you so much money you have no idea. My dad retired at a very early age, 57 years old, and for 10 years he was getting insurance that he had to pay in full, health insurance, and I want to say it was something like $800 a month for him and $800 a month for my mom. So they were paying $1,600 a month, which at the time was more than my mortgage payment, just to have health insurance before they could get Medicare. Once they turn 65, they make sure they're signed up for Medicare, and there's a bunch of different Medicare different parts of the plan that we'll touch on real quickly through this video. Again, back to your paycheck. So you have a portion coming out for Medicare, a portion coming out for a federal income tax, and a portion coming out for Social Security. Similar to Medicare, Social Security comes out, or a portion comes out, I think it's 7.65, 7 point something percent, or excuse me, 6.2% of your paycheck comes out and is paid to the Social Security Administration. Once you retire from work, you will get a monthly payment from the Social Security Administration as a kind of defined pension plan until the day you die. You can also file for Social Security from a dead spouse. If you don't remarry, you can file to receive their Social Security benefits, and you can also file to get them before you're the age of 65. So you make sure if a spouse dies, one of the first people you contact is the Social Security Administration to see if you qualify for any benefits, whether or not, regardless of your age. So something to check on. Now again, federal income tax, amount you pay is based on your marginal tax rate, and the amount your employer pays, you're the only one that pays your income taxes. And the maximum is, there is no max for federal income tax. Medicare, about 1.45% of your paycheck is taken out for this and set aside, and there is no maximum. So it doesn't matter how much you make, you will always pay 1.45% of that. For Social Security, it's usually pulled out and sometimes called FICA. And OSDI sometimes is what it's labeled on a paycheck stub is, oh, I forget what it's called, but it's something old persons, and I know the first word is old person in that acronym. So about 6.2% of your income is pulled out for Social Security. Now, there is a maximum, and this is kind of an argument of a lot of politicians and some folks is, our Social Security benefits that you hear about in the news, I believe will be only be able to pay through the year 2030 right now, and after that, there won't be enough money in there to pay out benefits at its current amount. And some politicians are arguing that this is because you don't have to pay Social Security taxes or money into the Social Security Administration once your income goes above $106,800. Anything after that, you no longer have to pay in that 6.2%. So that's the maximum. It would only ever be 6.2% of your income of $106,800. All right. So again, Medicare is the U.S. governmental health insurance program for people age 65 and older. Certain people younger than age 65 can qualify for Medicare too, including those who have disabilities and those who have permanent kidney failure. The program helps with costs of health care, but it doesn't cover all medical expenses or the cost of most long-term care. You can apply for Medicare even if you're not ready to retire. And Medicare, there's different parts to it. Typically, that whole thing about the 1.45% that comes out of your paycheck pays for what's called Part A of Medicare. And that is really looked at as, we kind of call it hospital insurance. And it pays for most inpatient hospital care, some inpatient skilled nursing home care, some home health care, and hospice care. You're automatically enrolled in Part A when you join Medicare. If you qualify automatically for Medicare through your own spouse or Social Security record, you do not have to pay a monthly premium for Part A once you're age 65. Then what you can do is sign up for Medicare Part B. So really this is just a catastrophic, if you have to be put in the hospital for a while, this will cover it. It will not cover, though, doctor services, outpatient hospital care, outpatient physical and speech therapy, home health care, ambulance services, and medical equipment and supplies. And those items can add up in a real hurry. So most people sign up for Part B once they turn the age of 65. And that pays for doctor services, outpatients, and all of these things. The monthly premium in 2009 was $96.40, so almost $100. I think it's a touch above that right now in 2016. And again, if you want to be able to go see a doctor and not an emergency room visit, if you need outpatient hospital care, physical or speech therapy, and home health care ambulance services, then you want to get Part B. From a financial perspective, everybody should be signing up for Part B. Then we have Part C. In Part C, you must be enrolled in Medicare Part A and Part B to be eligible for Part C. Part C comes from private insurers, for example, Blue Cross Blue Shield. And this will replace Medicare A and Medicare Part B and will add more benefits than A and B. It can either be a health maintenance, HMO, or private fee-for-service or paid plan provider is what PPO stands for. Then we have Medicare Part D. Part D offers some help with prescription drugs, and the coverage is voluntary, and the monthly premium varies depending on how much coverage you have. All right, so that covers, again, Medicare at the age of 65. Before you turn 65, you want to make sure you are enrolled in Medicare. Medicaid, similar to Medicare, is a health program for usually the poor and indigent. And there are folks that have very low incomes. And it's a mean-tested program that's jointly funded by the state and federal government, and it's managed by the state. Okay, so it's not for the elderly. It's usually for very low-income folks or fairly low-income folks, and as a way to help them out so they can have health care as well and have that paid for. Again, it's funded by the state and federal government jointly. A lot of times if the federal government wants to mess with a state, what they'll do is they'll adjust the amount of money they receive, and kind of manipulates the state to doing what the federal government would like them to do. All right, Social Security then. Social Security deducts about 6.2% of your wages up to $106,800. Now, with this, your employer pays another 6.2%. So you pay 6.2% and your employer pays 6.2%. It's a full match of that amount. And again, this is like it's a pension plan. When you turn age 65, you'll get a monthly paycheck. And it depends on how much you contributed, which will determine how much you're going to get back from the government. You can start withdrawing at age 62. If you withdraw at 62, you're going to get a smaller portion per month. The longer you don't take it out, the more you'll get per month. The monthly amount that you receive is determined by how much you contribute and how long you contributed. In June 2011, the average Social Security benefit was $1,180 per month. The maximum possible benefit at that time was around $2,300. And in order to get that $2,300 a month, you would have had to have that income. You would have been paying for your 40 working years. But B, you would have been paying in and have an average salary in the six-figure range in order to receive the highest benefit amount from the Social Security Administration. And how that system works is it's based on points. You need to receive 40 credits to get your full contribution from the Social Security system. Okay, then from there they look at how much you actually contributed to figure out how much your benefit's going to be. So 40 credits is equal to 10 years of full-time work and contribution to the Social Security system. 4 quarters equals 1 year, and 40 quarters equals 10 years. Again, you have to have 40 credits to apply for benefits, and there are some circumstances. Again, if you are totally and completely injured and you're 40 years old or 30 years old, for whatever reason and you can't work anywhere, you might be eligible for Social Security to receive some benefits through them. So again, typically you need 40 credits or have worked for 10 years in the system and paid into it, but there are some ways to get around that. And if you go to socialsecurity.gov credits, you can find that out. And that ends our video. I hope this was beneficial to you. Again, we didn't show you exactly how to fill out the 1040 form, which is the form you use to complete your taxes, but we did go over the formula and the concept behind it. Again, if you have any questions at any time, feel free to contact me. Thank you.